at Metropole TVKE across all your social media platforms. My name is Elijah Charles Kiage. Thank you very much for joining us this morning. You are watching a Business AM right here on a Metropole television. This is your economic review. Let me introduce the gentlemen who are joining us this morning. We do have Rufus Kamau. Rufus, good morning, sir. Rufus, can you get me?
Morning, Simba.
Fantastic. We can hear you now. How are you doing?
Yes.
Happy to have you around. Rufus is a research and markets analyst at Scope Markets. We are also joined by Justin Mwangi, who's an investment analyst. Justin, good morning, sir.
Good morning, Sim. Thanks for having me.
Anytime, man. Happy to have you around. Let's move on to that first issue this morning. Yeah. Now, banks were charging an average of 12.12% interest on loans in August, according to data from the Central Bank of Kenya. CBK making it the highest lending rate since February last year, when the average lending rate was at 12.19%. This coincides with the high inflationary pressures being experienced in the economy as the businesses reopen fully after the lifting of the curfew restrictions. Analysts are already pointing to the high inflationary pressure as a reason behind the bank rates. Now, this is unlikely to sit well with the businesses and the business community, with the cost of credit going up at a time when the private sector is expected to be behind the refueling of the economy through access to cheap loans. Let's look at that average commercial banks lending rate this morning so we can actually get to talk about it. And indeed, you can see that as from Q3, indeed you can talk about that improving or increasing, albeit to a lower degree, yeah, that's closing in on those numbers as well. And if we look at that inflation rate in the country, and we're looking at it in those different quarters, what we do know is that as from this month, then it dropped, albeit by just some points to landing at 6.45. But we do know again that indeed, if we look at those quarter by quarter inflation numbers, then you will talk about that being on a high. And if you look at the commercial bank's annual average lending rates, then you will see that was stuck for some time at around 12%. Now, those points that we're increasing here this morning are the ones that we're going to put into proper context this morning. Justin, let me begin with you this morning that the inflationary pressure could be behind the high lending rates that we're seeing right now. Could it just be down to that, or there are other factors that we need to look at this morning?
Thanks, Simba. Of course, the inflationary pressures have had an effect on basically all sectors, and in this case, even the banking sector. But it's down to many other factors, including inflation. It's down to inflation and other factors. And remember, we're looking at data as of August. This is whereby the inflation was reaching the 6.97 thereabout. Yeah. So this translates then to the banks wanting to improve what they're getting net from their lending rates. But also remember, the credit risk has remained elevated since last year. Just because we have reopened the economy does not mean that the quality of businesses or the economy, in as much as the businesses are improving, does not mean that the quality of credit and loans have increased significantly. The credit risk remains elevated. The banks have still to cover their bases. Yes. And if you look at the data as of H1 2021, the Npl ratio for the banks still remained high. It's improved this year, but if you look at the non-performance of the loans, it's at significantly higher rate than it has been historically. If you go back to the 2017, 2018, just looking at the average NPL rate for the banks over the last, let's say, 10 years, it's about 10%. It's currently at about 14%. So they have to look at that. They have to then see which are the ways in which they can ensure that they don't keep getting losses or keep writing off bad loans. One of the ways of doing that, of course, is better assessment, but also in this case, they're looking at the credit risk, which remains elevated, and they have to compensate. They have to compensate themselves for that risk. Yes. And that's why we are seeing that slight, I remember it's not significant for now, but that's why we are seeing that slight increase in the lending rate.
Pretty much. And that's why I want to pick it with Rufus. Rufus, if you look at that point, it's 0.8 from the average of around 12%. That's how we closed 2020. Is that significant for us to talk about, or it's quite insignificant for us to look at the effect this would have on the MSMEs that are looking for that money now to get their businesses out of the hold of the coronavirus pandemic?
Well, my main focus would be on the trend that we are experiencing right now. So if you look at the individual figure, it might not make a lot of sense.
Yes.
When you look at the figure of an extended period of time, then you notice that the rates are generally increasing. So ever since the rates were lowered back in March last year, we have been seeing these increasing over time. And as the economy reopens, we are seeing that this value tends to be going up.
Yes.
So if you look at the interest rates since 2018, we have been experiencing a rise over time. And when you compare these with what we are seeing with inflation, then it's also a similar curve. If you look at 2018, the annual average inflation was about 4.53%. Add half a point there, we have 5.19%, 5.67, and then this year we are looking at 6.07 average annual inflation. So with this kind of trend that we're experiencing, higher inflation, higher interest rates, then I believe something has to be done.
Yes.
So on the other hand, I believe it's a step in the right direction. So previously, we had over 14 million accounts that were listed with CRB, meaning that a lot of Kenyans could not access credit. So the tool was beginning to serve as a hindrance where the SMEs would not access credit. But with the recent suspension, I believe that more people will be able to access credit.
Yes.
Let's say you are involved with this financial institution, but this other financial institution doesn't have the information. So they may not have the credit score or your credit history, but somehow they'll find a way to give you a chance to get at least a loan, even though you're going to get this at a higher interest rate. So overall, we expect there will be more money flowing within the economy, but the cost of credit will be much or significantly higher.
Pretty much. Justin, I also want to pick it from where Rufus has left it right there. And it's a good thing that it's teased that point this morning. That right now, as we start today, we do know that moratorium for non-listing or blacklisting of loans that have been defaulted since 2020 to 2022 now in September. How does that sit with the lenders in the country? You see, Rufus is already saying that essentially what's going to happen is that then the cost of credit then is going to go up. Justin, is that what we are bound to see, even as we talk about the cost of credit? Is that another factor that's going to push the cost of credit upwards as well?
Yes, definitely, Simba. Rufus is right. And I'm going to pick it up from my left from the first question, which is the factors that are likely to increase in to lead to an increase in the lending rates. We have inflation, of course, which reduces real power of money. Banks have to compensate. Number two is credit risk, which in this point, credit risk is assessed in many different ways. One of the ways you assess that is through the credit worthiness of the consumer.
Yes.
If you do not have that information, or if someone is defaulted on their loans and that information is being denied to you, then that means there's an increased risk. There's the chance that a bank will be giving someone a loan, but this is someone who is not credit worthy, or maybe they will not. They may end up defaulting along the way, especially during this 1 year period.
Yes.
So what does the bank do? In that case, just to compensate for that additional risk by increasing the lending rate. And that is exactly what Rufus has said, and I agree that we're likely to see this lending rate increase, especially over the next 1 year during this moratorium.
Yes.
Then keep in mind that in as much as the government is doing its utmost best to cushion consumers against the rise in fuel prices globally, they will not be able to continue to sustain this for the long haul. So we'll see lending rates increase because of that uncertainty. It's not really increased credit risk, but uncertainty because you don't have enough information, because people are not being blacklisted as they were before. So, and number two, then we'll also still see other factors such as inflation to keep pushing the lending rates high. So it's in terms of how it will affect businesses right now are doing their most to recover. So we like to see high demand for loans. The good thing for now is that the costs which banks are paying to get money hasn't changed. The CBR rate, the central bank rate remains 7%. The deposit rates are not increasing. So the overall increase in lending rates will increase, mostly because of that credit risk element.
Yes.
But I don't see it being too significant, but it will keep increasing.
Yes. But Justin, for someone who's listening to this morning, we do know that the MPC is actually going to have their sitting again this month. Is there anything they're going to effect in light or in relation to the suspension of blacklisting? Because we do know yesterday when the Central Bank of Kenya Governor Dr. Patrick Njoroge was actually announcing the official start of that moratorium, he did say we risk going to the 2016-2019 levels where banks were very coy to release the money to the economy as a result of the cap on the interest rates.
Those are two things. We have first the MPC, the central bank rates, in terms of how they react. And remember, the number one goal for them is to keep the inflation rate in check.
Yes.
The inflation rate right now has declined in October, from September to October, 6.5.
Yes.
The current government efforts, all the IMF pressures indicate that we are likely to see it being contained for this, at least for the next, in the short term, within the government range, and probably around 6 to 7%. Thereabout. So in terms of the central bank rate, we don't anticipate that it will change from the 7.0% it's at.
Yes.
And then on the second element, which is now how will I put it?
Yes, Justin, if you may allow me to interject. I mean, you have a man in the name of Dr. Patrick Njoroge who's saying, well, is afraid that indeed we're going to the 2016-2019 levels where the cap on interest rates really did not allow the money to flow from the lenders in the economy to the mass market. Fine, and he's here saying, and he is quite cognizant of the fact that even the cost of credit now, as banks try and find their ways to lend to the economy, would go up. Don't you think that this necessitates monetary policy from the MPC?
You see, in most cases, our MPC is proactive, but I don't think it has come to a point whereby they see the cost of lending is going to increase so significantly that they have to look at revising the rate downwards, the central bank rate downwards.
Yes.
Because any action that they are to take, it's either they revise the rates downwards to improve private sector credit growth, or keep in mind inflation is going the other end. So will they be willing to increase the CBR rate so that they reduce inflation, so that there's less money flowing to the economy? So it's two contradicting pressures, one upward, one downward, which is why I'm saying we're likely to see them maintaining with a cautious look. Remember, that's what they said in August. Mm-hmm. We have noticed the inflation rate is going really high. We are going to maintain, but we maintain a cautious look. We'll keep monitoring the inflation rate. Now it has decreased, but now we are seeing something else happening. The credit, the lending rate is going up and is likely to keep going up. So what do they do? I still think they'll maintain, but we'll just wait and see what they do.
We just wait and see. Let me throw in a Rufus on that end as well. Rufus, you saw that communique yesterday from Dr. Patrick Njoroge, that's the CBK governor. He said that, well, this moratorium might affect lending from banks to the mass market. In fact, he was a bit afraid that we might be forced to get back into the 2016-2019 regime when the cap on interest rates was fully active, and we saw a dropped lending from the commercial banks in the country to the mass market. So when you're seated as the CBK governor, it looks as if this time there was that came from the president's side. It looks as if had the president gone and spoke to Dr. Patrick Njoroge first, then Dr. Patrick Njoroge would have told him, "Nah, just hold it back. Let it go on the way it is," because it sounded a warning yesterday when this moratorium was beginning. So from where you seated this morning, the NPC is supposed to meet this month Dr. Patrick Njoroge and the MPC are quite aware that the banks are going to get a big coin in terms of lending to the mass market. Do you think that for them to improve that lending to the mass market, then they'll be forced to get into some sort of monetary policy, Rufus? And if, what sort of form are we going to say it come in?
I think there is quite a number of factors involved here. First of all, we're already getting pressure from the IMF to implement certain changes within the system.
Yes.
To make sure that money is flowing and economy reopens and people get back to work so that we can be able to refinance our loans. So at the same time, Patrick Njoroge might be right on one way, but when you compare the scenarios, they are totally different. If you compare some few years back with what you're experiencing right now, the inflation rate was not that high. And we all know that inflation is very unforgiving, doesn't spare anyone. So as long as you are sitting on money, then you're going to be losing value over time. So these the guys with a lot of money holding right now will be commercial banks, and they don't want to sit on this money. A good example, yesterday the Equity Bank Group announced that they are giving 500 billion Kenya shillings to the SMEs. So with this announcement, it means that they are ready to push this money, even though they would have to do at a little bit higher interest rate.
Yes.
So they don't want to sit on this money. If they sit on this money, they are going to be losing value. They have a responsibility to their stakeholders. So in this case, I'm expecting that they are going to find new inventive ways to make sure that they push this money to the economy. This money is absorbed in the value chains. There's a higher production, and then they are going to be dealing with the repayment rates later.
Pretty much. Justin, clear the conversation on this then. I mean, from what you said, Justin, I mean, we do know how lending works. There's no, the banks are in the business of business. They can't lend blindly, per se. This moratorium, is it going to work negatively or the other way around in exactly what the president wants to achieve? Because the credit sharing, the credit information sharing system has to go on because a bank has to in some way know who they are lending to. Justin.
That's a very good question. What exactly will be the effect of this moratorium next year when we'll be assessing it, looking at today? So there's two ways about it. Of course, the intended effect is that because there's less blacklisting, people will be able to access more credits, especially MSMEs or even in self-individual entrepreneurs up to 5 million shillings.
Yes.
That's okay. That's the intended effect. The bank itself is not looking at it. It's looking at why, if this, and remember we are saying people who are defaulted are not being blacklisted. To what extent, they don't know. That's the main point. And that's why we are saying there's two things. Lending will still be there. We still have a lot of money that these banks have, and they have to push it so that they can, as you say, that's their core business. So they'll still be lending.
Yes.
I don't think it will be significantly adversely affected in the short term for now, because that's the main business, and they want to keep improving their bottom lines.
Yes.
And what the consumer will have to contend with is the fact that I may still receive this money, but I'll have to accept a higher interest rate.
That's it.
So the only question here is whether that interest rate will go to a point whereby it's prohibited to someone who's borrowing. For now, it doesn't seem so, as long as the current conditions prevail. But if for any reason whatsoever we see the CBR rate going up, we see inflation really going up to the levels it was starting to reach, almost breaching 7.0%, then that will be a cause for concern. But for now, in terms of the moratorium effects, honestly, in my personal view, I'm really trying to see how much of an impact it'll have in terms of a positive impact if it was there versus if it wasn't there.
Yeah. Where's your feeling? It's tilting towards the negative or positive?
My feeling is it may probably have very little effect. It's maybe positive to an extent, but little. So it's just positive, but not too much. That's my personal feeling.
All right, Justin. All right, let's move on to the next issue that we have this morning. Well, it's a huge blow for Kenya as the G20 leaders endorse the global minimum tax of at least 15% on corporations that was proposed by US President Joe Biden. Kenya was among the countries that rejected the proposal, which seeks to prevent multinationals from reaping more profits in countries where they pay little or no taxes. Now, the proposal, which was finalized in October by 136 countries, was on Saturday agreed upon by all leaders attending the G20 summit in Rome. This comes on the backdrop of concerns of multinational companies who reroute their profits through low tax areas or jurisdictions commonly known as tax havens. Last month, the Organization for Economic Cooperation and Development, OECD, stated that 4 countries, including Kenya, Nigeria, Pakistan, and Sri Lanka, were yet to join the agreement. With the approval, countries will have to abolish their unilateral digital services taxes on US tech giants, including Meta, Google, and Amazon, which is a huge blow for Kenya that introduced the digital services tax in January this year. Now, the proposal was adopted on Sunday and is expected to be enforced by 2023. Let's look at exactly how KRA has been performing on that front. And we're going to look back to 2020, 2021, and you will see their income profile. And you will see that 45% was from income tax, 27% VAT, and 4% was from other revenue. But you could see excise duty where it's coming from. And then others, that's what we're saying, other income, that's where we have the digital services tax, is exactly what made the 4% of KRA's revenue, or that's what the digital services tax was actually supposed to fall under that revenue. And you will see that for the very first time in 8 years, in 2020, 2021, they did actually meet their target. And the numbers that we're getting now from KRA is that 2021 has not been so bad for them, because apparently they are performing on a 104% ratio, meaning that they clear that way and jump 2021 again, then they might actually get close to meeting their targets. So question being then, is this going to be a blow to meeting that target? Woofers, just 20 million is what we could have gotten from this digital services tax, because the first time, and it's gone through a lot of revision, because we started it and then there was an uproar in the country on exactly how it was going to be applied. KRA went and sat down and they reviewed it and they said this was only for non-resident. But then on what platform? These are the people with platforms where businesses happen. And so when you narrow it down to that, it's just a couple of companies that would actually get to pay this tax. The likes of Facebook, Google, and the likes of Amazon, just 20 million. Why are we crying so much about 20 million at Rufus?
I would say that the current situation in Kenya, we already surviving by debt. And some of the lenders that are giving us money are very tough on our case. So whenever we take one more additional loan, be it IMF or any other country, then there's certain conditions that come from it and also certain expectations.
Yes.
So when we are borrowing, we are basing these on the cash flows. We're expecting to collect this amount of money from these, and that sectors. So if those sectors are not bringing the revenues, then we might default on those loans.
Yes.
So it's a very important cash flow, even how small it seems. When we are borrowing, we are basing that on the information. So on the other hand, when you look at the outlook of this whole scenario, I believe we are overreacting. We are only 4 countries that are going against this. And looking at the face value of it,
yes,
we are not losers. We are not losers in this agreement, because if we don't agree, then we continue losing revenue. If you look at the local companies that are already operating in tax havens, we have our neighbor here. We have Seychelles and the neighboring country. We know that there are a lot of Kenyan businesses have shifted their operations there, And we are basically siphoning money from Kenya and without paying the necessary taxes and using Seychelles as a way to get out. And this is causing a lot of stress within the economy. So one of the reasons we are losing cash flows, and this is from mainly bread makers in Kenya who are basically operating there. We have insurance companies operating in Kenya, Kenyan brands, but they are paying their taxes there where the rates are much lower compared to Kenya. I remember we entered into the double taxation agreement some time back, and this is leading to more revenues to those countries compared to this country. Same case is happening to retail supermarkets. I believe the top 5 big brands in Kenya, 4 of them are already siphoning money out there. So net on the face value, we are losing money to this agreement. And the 15% minimum tax is here to save us. Because if you look at it, it's only affecting the big companies. But for Kenya, we would also benefit much if we would even narrow it down to even smaller companies, sorry.
Pretty much.
So I don't get the sense of rejecting this agreement.
All right, Justin, do you share the same sentiment with both this morning? Because we've spoken to Kenya and we look at the amount of money that they were actually targeting to get from this digital services tax. It would be around 20 million or so. Is that enough for us to make noise about?
Yeah, yes. Yes and no. Remember the last time I was just saying, but my view is actually almost in line with what you're asking, which is it's not too high for us to be making noise about. But I will say any money affecting a business, remember we are trying to promote the business environment. We are trying to promote employment and an enabling generally business environment, not just for ourselves, for foreigners, because this mostly affects foreigners.
Yes.
So in that case, any extra taxation will affect the profits or profitability of these businesses. So yes, definitely, if I'm a business and there was not, this tax was not there before, it's going to be added now, I will make a noise about it. Now, looking at it from the revenue collector point of view, they are trying to increase the revenue. The revenue performance has been good so far this year. They still have targets they need to meet. Amongst the ways in which they're raising revenue is, of course, we've had additional taxes and other goods that were not there being taxed. And it's still in the same line. Remember, one of the reasons, and it's one of the things we've mentioned before, why IMF continued to extend or reach that staff level agreement with us last year, is because they see all the effort that KRA is doing to improve the taxes they're collecting, including this new tax.
Yes.
They see the performance. So to KRA, to the government, they need to collect money. If globally there is a digital service tax, but there is in other countries, that's why in other jurisdictions, then they see that this is something that is not too unreasonable to tax in Kenya. And that's why they're pushing for it. And remember, it's about precedence. The moment we get that through, it's passed through the courts, all the businesses are not agreeable, but no longer fighting it as much, then this is it. We'll have a DST, digital service tax, going forward. It won't be next year. We have still going back the same process. Is it good? Is it bad? We'll have it going forward. Of course, we can review the rates later. So they have to push for that, not just for this fiscal year, but also going forward, and also to show that they're doing the utmost best to provide the government with the finances it needs to meet all the ways it can raise revenue and repay the debts that it keeps getting. Some of these loans are concession.
Yes.
So they already have very lenient terms. You may as well show you the best efforts that you're raising revenue so that you'll be able to pay them back.
Pretty much. Gentlemen, I beg that we take a tiny break. Once we come back, the IMF case, they have done their 3-year lending review program to Kenya, and they are asking questions. We are also asking questions, and there is a lot of reforms that have taken place in majority of the public institutions in the country as well. Let's talk about that and ask ourselves the question, is IMF making us feel the heat? And why are we over-relying on IMF? Because indeed, if you look at that data set that was showing you, 2020 was the year we decided it's gotta be IMF or no other person. Once we come back here on a Business AM.